Ladies and gentlemen, if you've ever stacked silver and wondered how you actually compare to everyone else doing the same thing, today we're going to answer that with real numbers. As of this morning, June 26, 2026, silver spot is sitting at $65.56 an ounce. No, according to JM Bullion's live pricing, that's down sharply from the all-time high of 121.67 this metal hit back on January 29th of this year, which means we're in an interesting moment to talk about who actually holds silver, how much they hold, and where you might fall on that curve. So stick with me, because by the end of this video, you're going to know exactly what separates an average stacker from someone in the top 20%, the top 5%, and the rare top 1%, and you might be closer to that line than you think. If you are interested in money, finance, or changing your financial future, like this video and subscribe to Money Insiders right now, because what you are about to learn can change the way you see money forever. Let's start with the obvious question: who actually tracks how much silver private individuals own? And the honest answer is nobody does, not officially. There's no government census of silver stackers, no central database that says this person owns 400 O's, that person owns 20. What we have instead is a patchwork of data, total above ground silver supply estimates from organizations like the Silver Institute, COMEX warehouse reports, mint sales figures from places like the US Mint and the Perth Mint, and survey-based guesswork stacking community itself. So before we go any further, I want to be upfront with you. The ounce thresholds we're about to walk through are widely cited estimates that originated in stacker forums years ago, built using something called the Pareto principle, not an official government or industry survey. I'll explain exactly how that math works in a minute, because understanding the method matters just as much as the number itself. Here's the basic idea behind the Pareto principle, sometimes called the 80-20 rule. It's an observation that in a lot of real-world systems, a small percentage of participants hold a disproportionately large share of the total resource. Wealth distribution tends to look like this. So does land ownership. So it turns out does precious metal stacking. The original estimate that's been circulating in the stacking community, and that's been recycled in dozens of YouTube videos over the past few years, works backward from total estimated above ground silver, subtracts out what's held by governments, central banks, and large corporations, and then applies the 80-20 distribution to whatever is left over for private individuals. It's a reasonable thought exercise, but it is just that, an exercise, not a verified count. One thing worth flagging, honestly, the person who originally floated this calculation pointed out themselves that local bullion dealers alone can hold 100 times more silver than an average stacker, and that nobody really knows how much off-market silver sits with smaller regional businesses that don't show up in any official count. So the further down the supply chain you go, the fuzzier these numbers get. It also helps to understand why there's even a meaningful pool of above ground silver to argue about in the first place. And that means looking back further than this year's price swing. Silver actually has a long history of touching extreme highs and then giving most of those gains back. Prior to October of 2025, the metal's all-time high had stood untouched for 45 years, set on January 17th, 1980 at $49.95 an ounce. That 1980 spike wasn't really a story about industrial demand or supply deficits. It was the Hunt brothers, a pair of wealthy Texas oil family heirs, attempting to literally corner the global silver market by buying up both physical metal and silver futures contracts on margin. When the exchange stepped in and changed the rules, much silver could be bought on debt. The price collapsed almost as fast as it had risen. Silver tried again to break through that old high in 2011, reaching just over $48 before falling back. It finally broke through for good in late 2025 and then kept climbing into that January 2026 peak we've already talked about. Knowing this history matters, because every time silver has approached one of these historic ceilings, what followed wasn't a smooth continuation higher, it was a sharp, often brutal correction. That's the pattern stackers today are living through once again. With that historical backdrop in mind, here's where the percentile numbers tend to land, and we'll use them as a useful benchmark for the rest of this video. To be in the top 20% of private silver stackers, the widely cited estimate puts you at around 50. That's roughly 3 kilograms of silver, or about the weight of a bowling ball. To get into the top 5%, you're looking at somewhere around 150, call it 9 or 10 kilograms. And to reach that top 1% tier, the number most people are chasing when they search for videos like this one, the estimate lands at approximately 500 Oz. That's about 31 pounds silver, or just over 14 kilograms, depending on the form it's in. Some versions of this same calculation run on different stacker forums with slightly different assumptions about how much silver corporations and bullion dealers hold off market have put the top 1% threshold as low as 100 Oz or as high as 5,000 Oz. So treat 500 as a middle of the road estimate, not gospel. It's worth noting that some online stacker communities have run the same exercise specifically within their own membership, rather than across the broader global population of stackers. They tend to land on noticeably higher thresholds because, unsurprisingly, people who actively post on dedicated precious metals forums tend to already be more committed stackers than the general population. In those tighter, self-selected communities, the top 20% line sometimes shows up closer to 500 Aussies, the top 5% closer to $500, and the top 1% closer to 5. That's not a contradiction. It's a reminder the top 1% only means something relative to the population you're comparing yourself against. Being in the top 1% of casual, occasional silver buyers worldwide is a very different bar than being in the top 1% of people who spend their weekends discussing premiums and mintage numbers on a bullion forum. And if you wanted to go even further up the ladder, some of these same community breakdowns have tried to estimate a top 0.1% tier, the truly elite stackers, landing anywhere from a few thousand ounces up into the tens of thousands. Though at that point, the data gets so thin that it's really more speculation than estimate. Now here's where it gets genuinely interesting. This is the part most of these videos skip over. What does $500 actually cost you right now today at current prices? At $65.56 per ounce, $500 of pure silver would run you a little under $33,000 in metal value alone. And that's before any dealer premium, which on physical coins and bars typically adds anywhere from a few percent to 15% or more on top of spot, depending on the product and how tight the physical market is at the time. Compare that to where we were back in January when silver briefly touched its all-time high of 121.67 cents. At that price, the same $500 would have cost you over $60,000. So the entry price for top 1% status has roughly cut in half over the past 5 months just from the metal's own price action. That's worth sitting with for a second. The bar to entry for an elite tier of stacking has moved dramatically, and it had nothing to do with how much silver anyone actually bought or sold. This is a good moment to stick around for, because in a minute I'm going to walk you through why silver swung so violently between those two numbers and what that tells us about what kind of asset you're actually holding when you stack it. But first, let's flesh out where the line sits in real world terms most people can picture. 50 O's, the top 20% threshold is roughly 2 rolls of American Silver Eagles, or a modest collection most casual stackers build up within a year or two of buying a coin or two whenever they can. 150 O's, the top 5% line starts looking like a small home safe's worth of coins and bars. Still very achievable for someone who's been stacking with intention for several years. 500 O's, the top 1% line, is where things shift from hobby into serious holding. That's the rough weight of 2 cinder blocks, except worth tens of thousands of dollars. Most people who reach that level didn't get there by accident. They got there through years of consistent buying, often dollar cost averaging in during both high and low price periods, sometimes inheriting a parent's or grandparent's collection, and sometimes through a single large purchase during a price dip. The form that silver takes matters too, and it's worth touching on briefly because it changes how realistic any of these tiers feel in practice. A lot of casual stackers start with 1 OZ's government minted coins, things like American Silver Eagles, Canadian Maple Leafs, or Austrian Philharmonics, because they're easy to recognize, easy to resell, and carry a guarantee of purity and weight from a sovereign mint. The trade-off is that coins usually carry the highest premium over spot price of any physical silver product. Stackers who are trying to accumulate ounces more efficiently, especially once they're working toward a 500 Oz or larger goal, often shift toward generic rounds or silver bars instead, which typically carry a lower premium because they don't have the collectible or numismatic appeal of mint-issued coins. A single 100 O's bar, for instance, gets you a fifth of the weight to that top 1% threshold in one purchase, and usually at a meaningfully lower premium per ounce than buying 100 individual 1 O's coins would cost you. None of this changes the percentile math, but it does change how quickly and cheaply someone can realistically climb from one tier to the next. Let's talk about why this market has been so wild, because it directly explains why how much silver puts you in the top 1% is a moving target rather than a fixed number. Silver had an extraordinary 2025, gaining roughly 150% over the course of the year, one of its strongest years on record by any measure. That rally carried into January 2026 and pushed the metal to that nominal all-time high of $121.67 on January 29th, finally breaking a price ceiling that had stood in one form or another since the Hunt brothers tried to corner the silver market back in 19. After that January peak, silver corrected hard, falling into the 60s before staging a partial recovery, then getting whipsawed again by a combination of Federal Reserve policy shifts and geopolitical developments tied to tensions in the Middle East. As of this week, the metal has pulled back to the mid-60s, still up significantly from where it started 2025, but a long way down from January's peak. Why does this matter for stackers specifically? Because it shows you something important about silver that gold investors don't have to think about nearly as much. Silver behaves like two different assets stitched together. Part of its price is driven by the same safe haven inflation hedge demand that drives gold, people buying it because they're worried about currency debasement, geopolitical risk, or the Federal Reserve's next move. But silver also has a heavy industrial demand component that gold simply doesn't have at the same scale. Solar panels use silver in their conductive paste, electronic switches, and a growing list of applications in electric vehicles, and even some data center hardware all consume real physical silver every year. When industrial demand is strong and investment demand is strong at the same time, you get the kind of violent upward move we saw in 2025 and early 2026. When the Fed signals higher interest rates for longer, which raises the opportunity cost of holding a non-yielding asset, and industrial buyers start trimming silver content to cut costs, you get sharp pullbacks like the one we've seen since January. I want to bring in the supply side here too, because this is the piece that actually matters most for long-term stackers more than any single day's price swing. For multiple years running now, the world has been pulling more silver out of the ground and out of recycling than it's producing in new supply. A sustained multi-year supply deficit that the Silver Institute and several major banks have flagged repeatedly. Mine production has been relatively flat for years, partly because most silver isn't even mined on its own. It's usually a byproduct of mining for other metals like copper, lead, and zinc, which means silver supply doesn't really respond quickly to higher silver prices the way you might expect. Meanwhile, demand from solar manufacturing, electronics, and investment buying has kept climbing. That structural gap between what's produced and what's consumed each year is one of the real fundamental reasons silver's has had the kind of run it's had, separate entirely from any short-term price spike or correction. On top of that, if you look at COMEX, which is the main U.S. exchange where silver futures trade and where a lot of price discovery happens, the amount of silver sitting in registered deliverable vaults has been a genuine talking point this year. Registered COMEX silver, meaning the metal that's actually available to be delivered against futures contracts, has been sitting in roughly the 80 to 85 million Oz range through much of June, which is a meaningful drop from levels seen several years ago. That doesn't mean a delivery crisis is imminent. Most futures contracts get rolled over or settled in cash rather than turned into physical delivery demands. So a low registered number isn't automatically a 5-alarm fire, but it does mean the cushion of immediately available physical metal backing. The paper market is thinner than it's been in a long time. And that's part of why every COMEX inventory report gets so much attention from analysts right now. There's another data point worth bringing in here because it actually connects directly back to our stacker percentile conversation. Mint sales. Government mints like the US Mint and the Perth Mint publish how many ounces of bullion coins they sell each year. And that's some of the closest thing we have to a real verifiable proxy for retail stacking demand, even though it obviously doesn't capture bars, rounds, or secondary market purchases. When retail demand for physical coins runs hot, mints sometimes report sellouts or rationing of certain products to dealers, which is itself a signal that a lot of individual stackers are trying to add ounces at the same time. That kind of retail buying pressure tends to show up most during price dips when stackers see lower prices as a buying opportunity rather than a warning sign, which is a notably different psychology than how a lot of paper traders and short-term speculators react to the same price drop. So here's the question I promised to come back to. Does any of this actually change where the top 1% line sits? Not directly, no, because that line is based on total ounces held, not dollar value. Someone with 500 O's is in the same percentile bracket, whether silver is at 65 or 120. But what does change and change a lot is how much it costs you to get there and how much that pile of silver is actually worth once you've built it. That's the real lesson hiding inside this whole exercise. The ounce count tells you where you rank among other stackers. It tells you nothing about whether now is a good entry point, whether you're buying into a deficit market with real structural tailwinds, or whether you're catching a falling knife after a historic, partly speculative run-up that already corrected by nearly half once this year. Let's talk honestly about both sides of that coin, because a channel like this one isn't going to pretend either side doesn't exist. On the bullish side, the structural case for silver remains intact regardless of short-term price noise. The supply deficit is real, has persisted for years. Industrial demand from green energy and electronics isn't going away, and in fact, most forecasts expect it to keep growing. The gold to silver ratio, basically how many ounces of silver it takes to buy 1 ounce of gold, has spent most of this year in a range that many analysts consider historically favorable to silver relative to gold, suggesting silver may still have room to catch up if that ratio compresses further. Several major banks, including some of the largest names in commodities research, have put out price targets for the back half of 2026 and into 2027 that sit meaningfully above where we are today, with some forecasts clustering in the $80 range and a smaller number of more aggressive forecasts going considerably higher. On the bearish or cautious side, you have to seriously what just happened. Silver ran up so fast into January that multiple major banks explicitly flagged bubble-like characteristics in the price action, meaning a meaningful chunk of that move was driven by speculative momentum and leveraged futures positioning, not purely by physical supply and demand. When the Fed pushed back on rate cut expectations and geopolitical risk premiums started unwinding, that speculative froth came out fast, and silver gave back nearly half its gains in a matter of months. Solar panel manufacturers have also been actively working to reduce the amount of silver used per panel to control costs, which is a real headwind to one of the demand stories bulls love to cite. And if the Federal Reserve does end up raising rates further this year rather than cutting, that raises the opportunity cost of holding a metal that pays you no interest or dividend, which historically has weighed on silver and gold alike. This is exactly why I don't think chasing a top 1% badge should be the actual goal of anyone watching this. It's a fun benchmark. It tells you something about where you sit relative to other stackers. But silver, like any single asset, carries real volatility, and we've watched it lose nearly half its value in 5 months this year alone. If you're stacking silver as part of a long-term diversified approach, buying steadily over time, treating it as one piece of a broader financial plan rather than the whole plan, these percentile numbers are interesting trivia on the way to building real durable wealth. If you're trying to rush into $500 because a YouTube video told you that's where the cool kids are, you're optimizing for a status number instead of for your own actual financial goals, and that's a mistake regardless of which direction silver moves next. So what should you realistically take away from all of this? First, understand that the ounce thresholds for these percentile tiers are best estimates from the stacking community, not hard data, useful as a rough yardstick, not as a precise ranking system. Second, recognize that where silver's price sits dramatically changes the dollar cost of reaching any of these tiers, which means the value of being in the top 1% today is roughly half of what it was in January, even though the ounce count required hasn't moved. Third, keep the real fundamentals in view, a genuine multi-year supply deficit, growing industrial demand, but also real volatility risk in a market that just demonstrated in dramatic fashion that it can correct nearly 50% in a matter of months. None of this is financial advice, and I'm not going to pretend I know exactly where silver goes from here because nobody honestly does. What I can tell you is that understanding the real mechanics behind a number like $500 puts you in the top 1%, makes you a sharper stacker than just chasing the headline. One last thing worth mentioning before we wrap up. If you want to actually figure out where you stand using today's numbers rather than the figures from older videos circulating online, the math is simple enough to do yourself. Take your total ounces of physical silver, multiply by today's spot price of $65.56, and you'll know your current holdings dollar value. Compare that ounce count against the 50, 150, and 500 Oz benchmarks we walked through today, remembering those numbers are estimates, not certainties. And if you're nowhere near 500 Oz, don't let that discourage you. Most stackers aren't, and building a meaningful position in any asset, precious metals included, has always been a function of time and consistency rather than a single lucky purchase. If you learned something new today, make sure to subscribe to Money Insiders and like this video. More powerful financial truths are coming next.